Welcome, it's Ann Guerrero and Brent Brujink from Alaris Retirement and Benefits. Thanks a lot for taking the time to take part today. We expect this will last around 30 minutes. I've got everyone muted. However, I have the chat enabled, and I will take your questions at the end. Brent and I are based in the East Lansing, Michigan office. It is a beautiful day. I walked outside, I almost needed a jacket. Very unusual for Michigan in the summer, and I realize I'm speaking to people all across the country, so hope you're having good weather as well. Thanks for taking part, and I understand that those of you who are interested in this topic, understanding mutual funds, your knowledge and experience level could range from beginner to maybe pretty expert. So I generally direct my remarks to people who are more at the beginner end, but I think you'll all take away some great ideas and maybe ideas on how to manage the investments within your plan a little bit better. Thanks, everybody. Why don't you send a chat? I had not been sharing my screen, so now I'm sharing my screen and Investing 101. Just FYI, those of you who have attended, we've done 2 other quarters of these presentations, and we used to use GoToWebinar, and now we're using WebEx. And just as you're learning about mutual funds, we're mastering WebEx. So thanks for your patience. Our topics include reviewing what is a mutual fund, investing in mutual funds within your retirement plan, the different types of mutual funds that are typically offered in a retirement plan, and understanding and defining the risk associated with mutual funds in a retirement plan. So if we think about what is a mutual fund, I'm having a really great memory of working with some participants who were very, very new to investing. And we actually had a little kiddie swimming pool, because we always talk about mutual funds like a pool of investments. And we actually put different products in the pool. So I think we had like Pop-Tarts, I want to say, are they made by General Mills? And so we were putting different products in there that represented the typical large company stock fund. So if you thought about a pool of investments professionally managed, there might be anywhere from, say, 100 to more than 500 different stocks, if it's a large company stock fund, let's say, or hundreds of individual bonds if it's a bond fund. So that's what we mean by that pool of investments. So let's talk about how mutual funds make money for their investors. So if we talk about these funds as being professionally managed, and they're managed either by, say, an individual or by a committee of individuals, we are part owners of everything within that pool. So if there's hundreds of bonds in a, say, government bond fund, and there's thousands of investors and millions of dollars, everyone who takes part in the fund is a small part owner of everything within the fund. So if you think about how do we make money, every night at the end of the trading day, a mutual fund is valued. It has a number of shares and it has a price per share. That's the net asset value. And so we all own a certain number of shares, and that value can rise or fall every day. If it's a stock fund, it could generate some capital gains. Those are paid back to the fund, paid back to the shareholders, and we gain more shares. An example of a bond fund is the bonds could generate dividends or interest. Once again, those are distributed back to the fund and shared to the individual investors. So how do we benefit from taking part in mutual funds within our retirement plan? We mentioned that it's professionally managed. I said before, there's sometimes one manager with a staff, or sometimes it's a group of managers. They're very, very, let's take the third point, very, very diversified. Even if you're a beginner, you probably realize and have heard this message is don't put all your eggs in one basket. If you had $10,000 to invest, let's say you got an inheritance, you could buy just one stock with your $10,000, or you could invest in several mutual funds that invested in hundreds of stocks and hundreds of bonds. So your dollars are spread out over a number of investments, and it's cost effective not only for the fund but also for the participant. So for example, if I had $10,000, it'd be pretty challenging for me to buy hundreds of stocks and bonds, if not impossible. However, taking part in mutual funds, I'm part owner of thousands of investments. There's also cost efficiencies gained by the managers of the mutual funds. So instead of us bearing the cost of buying and selling individual investments, the fund bears those costs. So when we think about investing in mutual funds in our retirement plan, we sort of alluded to this when we talked about how do you make money in a mutual fund through your retirement plan. So if you think about and recall that as members of a retirement plan, we're sort of under this umbrella, the tax-deferred umbrella. So as our funds earn money, capital gains or dividends as they grow in value, no taxes are paid on those earnings until we withdraw them, typically at retirement. Additionally, as we get little pieces of the capital gains or dividends, they're not paid to us directly, but rather they're reinvested to buy more shares in the fund within the retirement plan. So that's a real advantage to own mutual funds in a tax-deferred retirement plan. Let's shift gears and talk a little bit about the risks that are associated with mutual funds within your retirement plan. So I use the word risk with a little bit of trepidation because in my years of experience as an education consultant and speaking with thousands of participants, often people express concern. Is this risky? Could I lose money? Especially when we see downturns in the market, there can be a lot of challenges and concerns expressed by participants. So I would like to redefine risk as simply uncertainty. Most people have sort of a negative connotation of risk. The risk is that my account could lose value. The risk is that I start with $10,000 and the market goes down and now only it's worth $8,500. But if you thought about risk as uncertainty, it simply means that we don't know from year to year the upturns or downturns. And that's exactly what I'm talking about in terms of market risk. So when people say they don't want risk, what they don't want is negative risk. Most of us would accept a positive or upside risk all day long. Oh, we don't know if the stock fund is going to return 12%, 13%, or 14%. That's a kind of uncertainty we can get behind, but the market risks are tied to the performance of the stock and bond markets. Let's talk a little bit about business risk. That gets back to the story I was talking about in terms of, let's say we inherited $10,000 and wanted to make some type of investment. You know, we could take that entire $10,000 and we could buy stock in, say, a new, small, up-and-coming company. And we sure don't know how that company is going to perform. Could it take off? Could it be run by Bill Gates out of his garage and turn into a vast billion upon billion dollar enterprise? Could it be the next Apple? Could it be a company that failed within the first year and we lose our entire investment? Well, we're not putting all of our money in just one stock or one company or one bond. When we look at mutual funds, our risk, the risk to any particular business or type of business, is spread out. So for example, let's say we're in a large company U.S. stock fund that as part of their holdings they invest in banks and insurance companies. If the banking industry has a tough year and some of those stocks don't perform well, not all of our money is in banking stocks. We're also in, say, retail stocks. We're in technology stocks. We're in pharmaceutical stocks. So we can really mitigate or maybe balance that business risk by being within a mutual fund. credit risk applies to bond funds. So let's take an example, a bond that invests in U.S. government bonds. Those are backed by the full faith and credit of the U.S. government. That doesn't mean the value of your shares cannot go up and down with interest rates. If you invest in what's called a high yield or a junk bond fund, those are corporate bonds that the companies that issue them are perhaps a little more volatile. So we always think about credit risk as associated with bonds. And then let's think a little bit about inflation. I think a lot of you are familiar with the term. Inflation has averaged about 3% since the Depression in the 20s. So when we think about saving for retirement, we're very concerned, can our earnings beat inflation? Can our earnings beat the cost of living rising every year? We're going to talk about some investments that are not guaranteed to beat inflation, but maybe a little more likely to beat inflation. Illuminating this risk idea a little bit more, let's look at this picture, and many of you have seen something like this before. So let's look in the far right-hand corner. That means higher opportunity for a greater return on our mutual fund investments. If we look on the left-hand side of the page, we balance that with the risk that we may undergo. So do you notice that low risk equals low return, and higher risk has the opportunity for higher return? And certainly I've met many participants through the year who are looking for a high return investment with very low risk. And you see that those two do not go together. So as Brent talks a little bit later, he'll illuminate this and talk more about it. But what I've shown you are categories that would pertain to the retirement plans that Alerus oversees. So for example, we're going to talk a little bit more, but on that low risk, low return, all of our plans have either a stable value fund or money market fund. So it's that person who's looking for little or no risk, all the way up to mutual funds that have the opportunity, the history of higher returns, certainly no guarantee going forward, but more risk, more uncertainty in the rate of return, the opportunity or possibility, not the promise for a higher return. Let's talk a little bit more about each of those concepts we just talked about. So the money market or stable value, depending on your plan. For example, many of the plans have the Fidelity money market. So Brent and I were talking, would you say right now less than probably a 0.5% return?
Yeah, it's on average you're going to look towards half percent or so for money market funds. You know, the idea is capital preservation. So it wants to preserve your money, not necessarily make it go up a lot or down a lot, but just kind of keep it consistently where it's at.
Right. So I sometimes call that the safe parking place. I even call it the scaredy cat fund, not in a negative way. If we meet participants who are uncomfortable with any uncertainty or unpredictability at all, we can always point out to them, hey, your retirement plan has this safe parking place. Moving on up the triangle, bond funds. So if you thought about a bond as a loan or an IOU, so for example, if we were to purchase, say, an individual General Motors corporate bond fund, we're loaning our money to General Motors. They make a promise to pay it back, both a principal and a set rate of interest. If we invest in a corporate bond fund, then those bond funds are promising to pay back both principal and interest to the fund, and as shareholders, we're part owners of a little piece of all of those bonds. Keep in mind that the rate of return can vary, and bond funds can even have a negative return because their returns are very closely linked to the ups and downs of interest rates. And you'll see that the investment grade, we would call that government bond. High yield bonds would be corporate, sometimes called junk bonds, simply meaning not that they're junk, but they carry more risk, opportunity for a higher payout. And then we have funds that invest in bonds from other countries. Stock funds, we have large, medium-sized, and small cap. That means capitalization. I sort of shortcut it by saying a small company or mid-sized company or large company, and your plan would typically have at least one of each, large, medium, and small cap stock funds, investing in the U.S., but also international, emerging markets, and sector. And Brent, you want to sort of explain what a sector fund, what you might see in a typical retirement plan?
Yep, so sector funds are going to specifically target particular industries, for that matter. So it could be something like real estate or technology or medical technology or medical devices, or even something such as precious metals. So it's an investment, a mutual fund that all the companies, all the investments held within that pool, as Ann said, are going to be specifically in one of those set sectors or industries. Therefore, it's going to decrease your diversification, and it talked about spreading out the risk through many different companies. This is going to do something similar, but keep in mind that you're going to be within that same industry or sector. So if, as a whole, that industry or sector does not do well, then your investment's going to go down more than if it was spread out amongst many different sectors.
Super simple example, again, if we thought that plastic kiddie swimming pool, if it was a sector fund, let's say real estate funds are pretty common in most of the plans that Alaris oversees. So inside the kiddie swimming pool, we would see shares of stock. You know, it's not individually owned homes. It's stock in companies that, say, buy shopping malls. They might invest in hotels, storage units. So inside our swimming pool are companies all in one area. So if real estate in general has a great year, we see some pretty dramatic upturns. If it suffers, we see some dramatic downturns. And remember, I told you the kiddie pool, if we were in, say, a large cap stock fund, we wouldn't see just individual stocks of, say, one area. We would see a lot of different areas like auto, like pharmaceutical, like retail, like manufacturing. Let's take a look at the next slide. And Brent's going to go a little bit further into this when he talks about his area. So he will let you know what does large cap, mid cap, small cap, what these means, because he's going to refer to a fund fact sheet. And he'll address that for you. And lastly, let's talk about your balanced funds and your asset allocation funds. So we often talk about people choosing investments within their retirement plan, and they're often pretty challenged, especially if they have little knowledge or experience. Most people say things like, I have no time, no knowledge, or no interest in picking and choosing individual mutual funds. So what all of our plans would offer is usually a balanced fund that might be, say, 60% stock funds and 40% bond funds, and a participant could put 100% of their deferrals in one fund and still be very well diversified. Secondly, our plans, and they're very, very popular, will offer, say, a target date fund or a risk-based fund. So some of you are familiar with these target date funds. They're tied to your approximate year of retirement. So for example, a 2045 fund is geared for people in the age group who are going to turn 65 in roughly the year 2045. Once again, those funds are hugely diversified. It's that, you know, buy the ready-made investment pie versus making your own pie. And many of our plans have risk-based funds. They're not tied to your age, but rather they're tied to your risk tolerance. So we'll talk about that in a minute. But for example, an aggressive fund might be like 90% different stock funds and 10% bond funds. A conservative or income managed fund might be, say, 30% stocks and 70% bonds. So you're still getting a lot of diversification, but you only have to make one selection. So many of you attended today because you wanted to gain more knowledge. Experts tell us that Americans spend more time planning their vacation than planning their retirement. So the fact that you're spending half an hour with us today, that puts you in the top, quartile of people who are understanding retirement. So this paper risk tolerance quiz is available. I can email it to you. And there's 2 versions on the participant website. One's an online completed version that you just do it yourself online, and you can get something similar to this online. So if you've been in your retirement plan for some time, you have never revisited the mutual funds that you selected, you might want to take this investor questionnaire and find out, what is my risk tolerance? The flip side of the quiz has some sample portfolios. So if you want to build your own investment pie, it would give you some examples of how much you should have in stock, how much you should have in bonds. Brent's going to take over. He's going to describe his role here at Alaris, and he's going to talk a little bit about the fund fact sheet, how to learn more about any particular fund in your plan.
Thanks, Ann, for that information so far. As Ann said, my name is Brent Brujink. I work in the investment advisory department of Alaris. So what my team does is, if a company or a plan sponsor chooses to hire us, then we would be the ones putting together your investment lineup and completing the analysis and the due diligence as time goes on to make sure that you're in the best investments possible. For today's purposes, I will be going over the fund fact sheet. So what the fund fact sheet is, it's going to be a lot of information about the mutual fund that you're interested in reading about or perhaps already investing in. They're going to look different because different vendors or companies produce fund fact sheets. On the screen, on the left-hand side of the screen, is the fund fact sheets that are very common with Alaris. If you access your your plan through the website, you'll probably see one similar to this. So I'm just going to kind of go over how to read it, what information you might want to look for and research if you're more interested in learning about the investments that you've chosen. So most fund fact sheets are going to include the fund name and description, which the description is just going to provide a short summary of the fund and its objectives. Secondly, let's move over to the right-hand side of the screen. I've kind of blown up some of the sections that we're going to discuss. It makes it a little easier to look at. And we'll go into the style box, which is that grid with a shaded box in it. So Ann had mentioned value and growth and large, mid, and small. So we're going to dive into that a little bit. So let's start with the value. So think of a value mutual fund as a fund where the manager is trying to find the companies that he or she thinks is the best value. Perhaps these are companies that may appear to be on sale, if you will, and the manager is going to buy them in hopes that they'll return to full price or retail price or even increase in value, hence creating those gains that Ann had mentioned earlier, making your portfolio go up in value, which is a great thing. Growth funds, for that matter, are a little bit of the opposite. These are investments or companies that the fund manager believes are maybe overpriced currently because there's a lot of hype or excitement about them because people anticipate them to grow rapidly, to explode in growth and earn excessive amounts of revenue, creating value for shareholders. Think of a company like Netflix, for example. Netflix is known for exploding in growth and currently and constantly trying to grow the company into a bigger and bigger company. This would be in that growth category. Or if you, so think of that. Explosive growth is where you're going to get your gains. That's the goal. And blend is right down the middle. It's a blend of these value companies. It's a blend of growth companies. And these are just strategies that the fund manager employs and helps you as an investor diversify the investments that you choose. On the right-hand side of the grid, you see large, mid, and small. This is market capitalization, which refers to how big a company is, basically in dollar amounts. So if you think about a large company, which is what this fund particularly invests in, is going to be companies that are valued at over $10 billion. So, and mid-cap, you're going to be in that $2 billion to $10 billion, and small cap, $300 million to $2 billion, just to give you a rough idea of the different sizes of these companies. So we'll look at the shaded box, which is what this fund is. It's a large cap blend fund. So it's going to be made up of large companies, some value, and some growth. To the right of that, you see asset allocation. This is going to help you determine what kind of investment this is. Is it a domestic stock fund? Is it a foreign stock fund? Is it a bond fund, et cetera? As we can see, it's significantly weighted in the domestic stock portion of it, 98.59%. So we now know this is a domestic stock, meaning companies in the United States. Next, we'll head to characteristics, and I would say asset class is important. It's the stock fund. As you can see, the category large blend, we've identified that by using the style box. The next piece is the ticker. So sometimes if you're watching TV and you see the tickers go scroll across the bottom of the news, or hear somebody talking about AAPL, which is Apple's ticker, you now know they're talking about the symbol that the stock market uses to list the companies. So for example, for this fund, if you went to Google and you typed in VFIAX, you would pull up a lot of information about this particular mutual fund. As we'll continue down and go to turnover. So turnover is the percentage of investments that are bought and sold within the mutual fund during the year. So it can be either a low number and a high number. Neither one is good or bad. It just depends on the strategy of the fund manager. So for example, with this fund, we know it's an index fund. So what that means is this fund its goal is to mirror the S&P 500 index, which is a stock exchange. So there's not going to be a significant amount of turnover because the goal is just to do exactly what the stock market's doing. Whereas if you go to what's called an actively managed fund, this is a fund where the fund manager is going to continually try to outperform the stock market. So you may see a higher percentage of a turnover because the fund manager is buying and selling more companies in pursuit of higher returns for the investors. And then we'll go into the number of securities. This goes back to what Ann was saying about diversifying and not putting all your eggs in one basket and having a pool of investments. So number of securities is 511. That means this mutual fund invests in 511 different companies across America because this is a domestic stock fund. So this number could be small, it could be large, it could be even larger. It really all depends on the goal of the fund. From there, we'll go to the largest holdings. This is going to be a portion of those companies that the mutual fund has the highest weighting in. So you see Apple, 3.6%, Microsoft, 2.55%, and so forth and so on. It's going to be the companies that have the highest percentage of your dollars are in those companies. And this also ties to diversification because, for example, let's say that Apple goes completely bankrupt tomorrow and loses all of the money and goes down to zero. We know that this fund will probably lose some value, right, because 3.6% of the money is in Apple, but you know, it's 96% or so of the rest of the money is in 510 other companies. So just because one company goes down doesn't necessarily mean that all of the companies are going to go down. And quite frankly, what will happen is some will go up and some will go down, or maybe one day they'll all go up or they'll all go down. That plays back to the diversification aspect of it. So we're not so worried about one company losing money because there's 510 other ones to make up for that. We'll skip down to the fee summary and go to the net expense ratio. So as you see here, it's 0.04%. This is the expense that you pay to be in this investment. And this is the money, this is how the fund managers make their money. You pay them for your service. So you're paying 0.04% of the money you hold in this investment. So if you have $1,000 in this mutual fund, you're going to pay the fund manager 40 cents, and they just take that right out of your account. So it's nothing that you don't have to write a check or anything to them. That's already taken care of. Finally, we'll skip down to returns and performance. This is a big piece that a lot of people can get hung up on, and I like to caution that because I'm sure you've heard that past performance is not indicative of future results or future performance, or nobody has a crystal ball, things of that nature. This is where this ties into. So we can see, we like to look at performance to make sure that the fund is performing well, or how much loss there is in a bad year. So take 2008, for example. This fund was down negative 36.97%. That's pretty terrible, and I'm sure a lot of people were kind of freaking out about that. They lose almost 40% of the money in their fund. But now we look at 2009, 2010, 11, 12, and so forth and so on. Look how this fund has continually gained in value. So what I like to say is if you would have sold this fund out of emotion in 2008 and you would have ate that minus 36.97% loss, you would have missed out on all of the gains that have happened in the subsequent years. And this kind of turns back to that long-term investing or that buy and hold strategy where you'd be safe if you would have just bought and done nothing up until, well, ideally for the next 10, 20 years until you retire. So we don't want to necessarily focus so much on the downturns or the upturns, but just know that, you know, what goes up must go down, and it's probably going to go back up again. That's safe to assume, and so we look at the history of the stock market, and it proves that as well. So that's kind of my brief overview of the fund fact sheet. Again, it's to help you as an investor kind of do a little bit of a deep dive and start to scratch the surface of what the mutual fund holds so you can get a better idea of what you're putting your money into.
And Brent, we did get a question from the chat where a little bit we were talking about the fees and expenses, and this is a pretty common question from participants. So we look at what that is for this particular fund, but how would you put that into perspective?
Yeah, that's a great question. So you'll see some expense ratios very low like this one, or maybe they might be closer to 1%. It really depends on the mutual fund, the investment itself. So this fund is pretty vanilla. It's pretty basic. Its goal is to track the stock market. There's not a whole lot of work that needs to go into it to achieve its goal. So therefore, the expense ratio is fairly low. If we find an expense ratio maybe at 0.8% or 1% for that matter, it may be that we're paying the fund company who is employing maybe advanced trading strategies or more exotic of a fund, perhaps something that's deep into emerging market sector, solely investing in oil companies in Brazil or something along those lines that is going to require a significant amount of research and due diligence and analysis that's done by the fund company to ensure they're trying to get the investor the best gains as possible. In essence, the goal is to beat the stock market. So I guess you're paying for maybe for the amount of work that's going into it from the fund company. The operating expenses are going to be a little bit higher with some of these more exotic or specialized investments. So you're going to see a range of fee expenses. They're not necessarily that higher is bad. We just have to understand exactly what we're paying for and how that cost is justified, if you will.
Thanks for that, Brent. I would like to be on the research team that is going to Brazil. I don't know if I'd like the actual work of interviewing the people at the oil companies.
So more the vacation part for you, Ann.
Yeah, I'd like to. We're on the home stretch, people. Thank you. So let me remind everybody about the participant website. This is where you can find these updated fund fact sheets. It's on the website. And additionally, we mentioned the ticker. That's on the fund fact sheet, but there's also just a tab that says investment performance. So what I like about the participant website is you can gain as little or as much information as you need. So I have a feeling there's some people here today that will there's some people here today who will appreciate those fund fact sheets. I think others will actually use the ticker symbol and they will put that in their search engine and they will actually either go to the website of, say, the Vanguard or Fidelity Fund. Maybe they even want to look at a prospectus. So the information is available as deep as you need to go. I've given you the website address. If you have never logged in or it's been some time since you logged in and you're locked out, I'm going to show you the toll-free number because you need a user ID and a password. Alaris is recommending that participants access the website at least once every 6 months. If it's longer than 6 months, for security reasons, you'll be locked out and you need to sort of trigger that forgot password tool, or some folks that I've never logged on or it's been a couple years. So dial that toll-free number to get access. So here is the toll-free number, and in the Eastern time zone, it's 8 a.m. to 7 p.m., so just think about what those time frames mean in your own time zone. And by pressing 2, that is the dedicated line, simply if you need assistance with the website. Brent's going to return. There is an additional question here, and he's going to go ahead and take that question. I want to thank everybody for taking part, and you have my email address, so feel free to email me, hey, Ann, I need those handouts. We're recording one session of the 3 today. We'll make that available. We'll make that available to plan sponsors so they can share it with others. People can listen to it again.
Yep, so what question we got is a higher turnover rate indicate higher turnover fees and more taxes. So technically, yes, when a mutual fund company is selling and buying and selling stocks, you have to pay taxes on those gains, whether they're like a short-term or long-term tax rate, and that will differ and vary. So yeah, those are impacted, and those are absorbed by investors paying those expenses. So that is a great question and very true.
Keep in mind, though, more broadly, this is under the umbrella of your tax-deferred retirement savings plan. So, for example, if we took that $10,000 inheritance and simply invested in a mutual fund that had a high turnover rate, those managers are buying and selling very actively, that is a true statement. So any taxes that are triggered if we're beneath that umbrella of the retirement savings plan, of course, we don't pay any taxes until retirement. It looks like I'll give you a minute or two for any more, but we've kept it to a nice time of maybe just a little bit over 30 minutes. We did record it. I wanted to thank you very much for taking part, and we look forward to inviting you to the next series that we'll be doing in the next quarter. Thank you very much.